Billionaires use a variety of complex tactics to protect their money and manage market volatility during uncertain economic times. Through the use of diversification, liquidity, and resilient asset investments, they put themselves in a position to both safeguard their wealth and take advantage of new chances. Here are 7 key strategies that the ultra-wealthy use to shield their investments during downturns. Number 7. Diversification of investments. A key financial tactic used by billionaires to protect their fortunes from the inherent risks of economic downturns is diversification. The idea behind diversification is straightforward. Investors can lessen their exposure to any one market or economic event by distributing their money over a variety of asset classes, including stocks, fixed income, real estate, private equity, hedge funds, and commodities. For example, falling business profits and decreased consumer spending may cause stock prices to fall during a recession. However, as investors look for safer investments, bonds frequently gain appeal, which causes fixed income instruments' prices to rise. Rental income from real estate can generate consistent cash flow, even in the face of fluctuating stock markets. Furthermore, alternative investments that are less linked to public markets, such as venture capital or private equity, may yield larger returns. To make sure that their portfolios are balanced and resilient against a range of economic scenarios, billionaires frequently use complex asset allocation models that consider market movements, macroeconomic data, and historical correlations between various asset classes. In addition to reducing possible losses, this strategic diversity puts businesses in a position to seize expansion opportunities in many industries and regions as market conditions change. Diversification essentially serves as a hedge against volatility, enabling millionaires to hold on to their money even during tumultuous times. Number 6. Focus on cash reserves. For billionaires, keeping large financial reserves is a crucial tactic in difficult economic times. Because cash offers flexibility and liquidity, they can handle financial difficulties without having to sell investments at a loss. During downturns, when market circumstances can cause sharp drops in asset values, this liquidity is particularly crucial. Billionaires who have cash on hand can pay for operating or personal expenses without having to liquidate investments or take out high-interest loans. Additionally, having cash on hand allows businesses to take advantage of investment opportunities that present themselves during market downturns, such as buying distressed assets or undervalued stocks at a discount, setting them up for future growth when the market recovers. For instance, because they had enough cash on hand to buy when others were compelled to sell, many billionaires were able to take advantage of distressed real estate and stock possibilities during the 2008 financial crisis. Cash also serves as a psychological buffer against market volatility, enabling billionaires to make logical and composed investing choices rather than emotionally responding to fluctuations in the market. They are ready for both immediate requirements and long-term investment opportunities because of this strategic focus on liquidity. In the end, having a sizable cash reserve gives billionaires the ability to take advantage of favorable circumstances that may present themselves during economic upheaval, in addition to offering security. Number 5. Investing in non-correlated assets. Billionaires employ a clever strategy to shield their money from the inherent hazards of traditional financial markets, investing in non-correlated assets. Physical assets like real estate, precious metals like gold and silver, collectibles like artwork or vintage automobiles, and even cryptocurrencies are examples of non-correlated assets whose performance does not move in lockstep with stocks and bonds. These assets can be useful hedges against inflation and currency depreciation because they frequently maintain their intrinsic worth. For example, gold usually gains value during times of economic instability or high inflation, as investors look for safe haven investments that hold their value. This was the case during the COVID-19 epidemic, when rising desire for security amid uncertainty caused gold prices to soar. In addition to capital growth, real estate can yield steady rental income, which is especially useful during uncertain times when other sources of income may be erratic. During downturns, properties in desirable locations typically hold their value better than those in less desirable areas. Billionaires build a more balanced portfolio that is less vulnerable to market swings by diversifying into these uncorrelated investments. In addition to offering chances for growth outside of conventional asset classes, this strategic allocation aids in their ability to sustain wealth stability. Additionally, billionaires might access specialized areas that might present special growth opportunities unrelated to the major financial markets by investing in alternative assets. Number 4. High-quality dividend stocks. During economic downturns, billionaires who want to create steady income streams choose to invest in high-quality dividend equities. Strong cash flows, sound balance sheets, and long-term business plans are characteristics of companies that regularly pay dividends. These businesses are frequently leaders in their fields and have successfully survived past economic downturns. For instance, industries like utilities and consumer staples are typically less vulnerable to them since they offer necessities that people always buy, regardless of the state of the economy. Dividend payments offer a consistent income stream during downturns, which can help offset losses from falling stock prices. This is especially crucial when capital appreciation is constrained by unfavorable market sentiment. Additionally, reinvesting dividends enables investors to compound their profits over time. For example, even in difficult times, reinvesting dividends into more shares of stock instead of cash payouts can greatly boost total portfolio growth. Because of their proven track records of financial stability and shareholder commitment, dividend aristocrats companies that have raised their dividends annually for a long period of time, usually 25 years or more, tend to be more resilient in economic downturns, which is why billionaires frequently target them. This approach guarantees a steady return on investment, which not only supports short-term income, but also long-term wealth-building objectives. Number 3. Dollar cost averaging. During downturns, billionaires use dollar cost averaging as an investment strategy to lower the risks related to market timing and volatility. This strategy allows investors to buy more shares at low prices and less shares at high prices by continuously investing a set amount of money at regular intervals, independent of market conditions. In addition to reducing the emotional strain that comes with trying to time the market precisely, this methodical approach to investing helps lower the average cost per share over time. Many investors suffer from the fear of missing out on opportunities during dips or making large investments at peak prices. Dollar cost averaging, for example, allows billionaires to profit from lower valuations during a downturn when stock prices drop sharply, without having to worry about making a big, untimely investment. This methodical approach promotes ongoing investment even in the face of uncertain or negative market sentiment. Furthermore, DCA strengthens the idea that markets typically recover over time despite brief setbacks by encouraging a long-term outlook that is more concerned with future recovery than with short-term swings. In the end, billionaires smooth out the effects of volatility on their overall investment performance and position themselves for larger potential rewards when markets inevitably rebound by using dollar cost averaging efficiently over years or decades. Number 2. Tax loss harvesting. Billionaires employ tax loss harvesting, a sophisticated tax tactic, to minimize their tax obligations during recessions while preserving a profitable investment plan. By using this strategy, they can reduce their overall tax burden and reposition their portfolios for future growth opportunities without having to pay the additional tax penalties associated with selling profitable investments outright. It entails selling underperforming investments at a loss in order to offset capital gains realized from other profitable investments within the same tax year. To offset those gains against taxes due on realized profits from winning investments, they might, for instance, sell losing positions in other sectors before year-end if they have sizable gains from stocks that have performed well, but also hold losing positions in other sectors, possibly as a result of industry-specific difficulties. Furthermore, investors can strategically rebalance their portfolios based on current market conditions and reassess the performance of their holdings without facing immediate tax consequences on realized gains from profitable investments sold later in the year after losses have been harvested. This makes tax loss harvesting especially advantageous in volatile markets where asset values fluctuate significantly by encouraging investors, including billionaires, to routinely assess the performance of their holdings against more general market trends. This strategy improves after-tax returns while promoting continuous portfolio management. Number 1. Geographic diversification. For billionaires looking to diversify their investments over multiple international markets and reduce the risks associated with home economic volatility and geopolitical unpredictability, geographic diversification is a crucial tactic. They can lessen their exposure to localized risks like economic recessions or political instability that could negatively impact particular areas or industries within their home country by investing abroad, whether in developed economies with steady returns or emerging markets with significant growth potential. For example, one region may be thriving due to favorable conditions like technological advancements, driving innovation, creating new consumer demands, leading to rapid growth opportunities across sectors, benefiting investors who diversify geographically accordingly, while another may be experiencing recessionary pressures due primarily local factors like rising inflation or supply chain disruptions caused by global events like pandemics or wars affecting trade routes, negatively impacting certain industries disproportionately compared to others globally. Investing in a variety of currencies strengthens this strategy, since currency fluctuations can also present additional opportunities for profit depending on exchange rate movements relative to domestic currencies involved in transactions executed overseas. Geographic diversification enables billionaires to not only protect themselves against localized downturns, but also take advantage of global growth trends that arise independently of domestic conditions. Additionally, having assets denominated in multiple currencies may benefit them from positive exchange rate movements while lessening the impact of currency depreciation in their home nation. This strategic allocation helps mitigate against currency risks. In the end, the tactics used by billionaires to safeguard and increase their wealth during recessions emphasize the significance of proactive financial management, diversification, and well-informed decision-making. If you liked our video, please hit the like button and subscribe to our YouTube channel.